So the Bank of England have just announced that interest rates will be staying at 5.25%, even though inflation has just gone down to 2%, which is the Bank of England target. So what does this mean for our individual pensions? Well, if like me, you're a little bit nervous about the value of the stock market at the moment, with particularly US stocks running at 35 times price to earnings ratios, then you may have some of your pension investments in either cash or money markets. Now, a higher interest rate for us, if you do have money in cash or money markets, means we'll be getting a better rate of return. So, for example, I have quite a lot of my pension in CSH2, which is an overnight money market fund. And for that, I get around 5.25%, which is what the Bank of England announcement is today. And if my bills are going up by 2%, that's a good thing for me. Now, obviously, it would be better for me if I had my investments in something like a world ETF, which at the moment is running around 9%, probably higher for the year, actually, this year. But for me, I've been a little bit nervous about the price of particular indices around the world, then having some money market funds is great for two reasons, really. A, I'm getting 5.25%, very much like the interest rate. Inflation's down to 2%, so that's great. But also, I can quite quickly sell anything I have in that CSH2 fund and quickly then go out and buy shares if I do see a significant drop over the next week, day, month, whatever period. So it gives me a bit of flexibility really to go in there. Now, what the Bank of England have said is that the door's open for interest rates to start coming down as soon as potentially August, which means at that point, it's likely then CSH2, the interest rate that I'm getting on that, will drop as well. At that point, I really need to think about, is it still giving me an appropriate risk return for the amount of cash you got in there, or should I really take some higher risks and start putting more of that into stocks? So that's where I am with the announcements today. For me, it's a good thing that interest rates have stayed high because of the savings I've got. If you have a rather large mortgage and less invested in savings, be they pension savings or other savings, then it's probably not such good news for you guys. But we will be seeing changes in that soon. So thanks for listening. If you, I know this was a quick catch up, but if you do get a chance to click like on this, it'll help us build the community. Thanks. So if you've heard my outro, then thanks for listening. And if you haven't, then here's probably the most important bit of investing advice you'll hear on YouTube. Don't buy or sell shares in a company based on what someone on YouTube tells you. The big Wall Street analysts have large teams of professionals with access to vast amounts of data on every single listed firm. There are no YouTube gurus who know better than them. Use YouTube to find interesting bits of information on companies that you may otherwise miss. And when you find something interesting, do your own digging and see what the analysts in the big firms are saying. Never invest more than you can afford to lose, and don't expect to get rich quick. If you are interested in my background, I come from 16 years in risk management with PwC and Deloitte. I've never been on a trading floor in my life, but if I had, it wouldn't give me the edge on the big firms because they have big teams and masses of information. So don't look for a guru with an edge. Look for information on companies you're interested in. And if you're looking to invest a large amount of money, don't put it on individual stocks. Choose an index fund. The All World Index is a representation of all the stocks in the world. And if one company goes broke, then the index won't even move. Whereas if you've only invested in that one company, then you may have just lost your pension. Keep it fun, keep it affordable, and subscribe to keep getting my updates. Thanks.